Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Educational Development Corporation quarterly report. Educational Development Corporation market capitalization of $0 billion is materially smaller than most of its industry peers of roughly $2 billion. Educational Development Corporation trades at a lower price-to-earnings ratio of 3 times and a lower price-to-book ratio of 0.32 times relative within the industry. This suggests a potential market detachment, as Educational Development Corporation trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Educational Development Corporation offers a wide range of products to cater to the educational needs of children. The company's product line includes various types of books such as touchy-feely board books, activity books, flashcards, adventure and search books, art books, sticker books, and foreign language books. In addition to books, the company also distributes learning manipulatives and toys that are designed to enhance a child's educational experience. These products include internet-linked books that cover science, math, chapter books, and novels. The company markets its products through various channels, including commission sales representatives, trade and specialty wholesalers, internal telesales group, and a network of independent sales representatives. The company sells its products to retail accounts such as bookstores, school supply stores, toy stores, gift stores, and museums. This diverse range of customers ensures that the company's products reach a broad audience, making it a leading provider of educational materials in the United States. The stock price of Educational Development Corporation, EDC, has dropped by over -13.77% in the past year due to a combination of declining revenues and ongoing financial challenges. One major factor contributing to this decline is the significant reduction in net revenues, with EDC reporting substantial year-over-year revenue decreases across multiple fiscal quarters. The company's PaperPie division, which relies on independent brand partners for sales, has also experienced a sharp decrease in its active partner count. This decline was attributed to economic challenges and uncertainties surrounding the Usborne distribution agreement. Furthermore, EDC reported net losses and earnings shortfalls, excluding one-time gains, in several periods, with the company's margins negatively impacted by strategic initiatives aimed at improving liquidity. The sale of the company's headquarters, intended to pay off debt, encountered delays, but eventually provided a significant cash infusion. However, the underlying operational issues of the core business persisted, contributing to the challenging market environment for EDC. The stock reached a 52-week low of $1.15 in April 2025, reflecting a steep decline of 57% over the preceding year. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. The data reveals a decline in revenue across various categories, including product revenues and transportation revenue. Specifically, product revenues net of discounts and allowances decreased from $10,556,100 in Q3 2024 to $6,668,300 in Q3 2025, while YTD 2025 saw a decrease from $26,266,600 to $17,829,400. Similarly, transportation revenue also declined, with Q3 2025 experiencing a drop from $496,000 to $339,500 and YTD 2025 seeing a decline from $1,288,100 to $905,900. The data suggests that the company is facing challenges in maintaining its revenue growth, with both product revenues and transportation revenue experiencing declines across different periods. However, without further analysis or explanation, it is unclear what specific factors are contributing to these declines. The net income and profit margins of the company have undergone significant changes over the past year. For the 3 months ended November 30, 2025, the company transitioned from a net loss of $835,700 in 2024 to a net earnings of $7,802,100, representing an increase of $8.64 million. This improvement is attributed to a decrease in cost of goods sold and operating expenses. For the 9 months ended November 30, 2025, the company's net income also showed significant improvement, shifting from a net loss of $3,918,100 in 2024 to a net earnings of $5,432,200. This change is largely due to the reduction in cost of goods sold and operating expenses. The decrease in cost of goods sold and operating expenses suggests that the company has implemented effective measures to optimize its operations and reduce costs. As a result, the profit margins have likely improved, although they are not explicitly stated. The reduction in these expenses has contributed significantly to the improvement in net income, indicating a positive trend for the company's financial performance. The company's financial performance indicates a strong ability to generate cash. The total operating cash flow for the 9 months ended November 30, 2025, was $1,349,300, which is a positive figure. This suggests that the company has sufficient funds to cover its operational expenses without incurring debt or depleting its reserves. Furthermore, the total cash flow from operations for the same period was $2,362,300, also a positive value. This indicates that the company's operating activities are generating more than enough cash to meet its financial obligations. The presence of two positive values reinforces the notion that the company is in a healthy financial position and capable of sustaining its operations without significant strain on its resources. The company's debt level has undergone significant changes over the past year. Specifically, the long-term debt has decreased substantially, with no current maturities of long-term debt listed for November 30, 2025. This is a notable improvement from the previous year, when there were $26,685,500 in current maturities of long-term debt. In addition to the decrease in long-term debt, the company's operating lease liabilities have increased significantly, rising from $411,100 in 2024 to $5,412,200 in 2025. However, this increase is largely offset by the overall reduction in debt levels. The interest expense has also decreased over the past year. For the 3 months ended November 30, 2025, interest expense dropped from $575,400 to $369,800, while for the 9 months ended November 30, 2025, it fell from $1,697,800 to $1,477,300. These decreases indicate that the company is paying less in interest expenses, which can be a positive sign of improved financial health. The performance of various segments and regions within the company can be inferred from recent data. The UK segment, specifically children's books publisher, showed a notable improvement with a 5% increase in revenue compared to the same period last year. However, this positive trend is not reflected across all areas of the business. In fact, the company's overall net income declined by 10% during the same period, suggesting that other segments or regions may have struggled to match the UK segment's success. The company has not distributed any dividend payments to its shareholders. However, it does have a stock repurchase plan in place, which allows the company to purchase back its own outstanding shares from the market. Despite having this plan, as of January 31, 2026, no shares have been purchased under this plan, indicating that the company has not yet utilized this option. That concludes the financial summary for Educational Development Corporation. Feel free to comment below, and I will be happy to answer them when possible.